I think that I shall never see a webinar worse than this one. Well, you've done it. You've joined the webinar. We now have control over your computer and your phone and your Apple Watch. And now you will see, against your will, completely useless information from a presenter who's not even smart enough to be a puppet. But if you have questions, you can send him an email, and I will answer that email, typing one finger at a time. It takes a lot to be a puppet. And if you want to be a tax puppet, then it's really, really difficult. So we've prepared slides and jokes and all sorts of entertainment, really insightful things, and he's not going to use any of that. All right. Hope you can wake up after this presentation, and thank you very much. Alan, I got him ready. Oh, good. What did you say? Oh, great things about you. Oh, thank you very much. All right. This is one of my favorite things to do on a Saturday, especially if it's 8 a.m. in California, where a lot of you are. I am Alan Gassman. I'm a lawyer in Clearwater, Florida, and this is the Layman's Guide to Federal Estate Tax Planning. It's going to go for 60 minutes. It's going to actually seem longer than 60 minutes. And I have both slides and slips and slides, and we're going to use the Estate View software as well. Once you've seen how this works, if you'd like to try it out, if you're not a subscriber, you can go to estateview.link, put that in your browser, and then set up an account, use the Creative Words free trial, and you'll have 30 days of use, and your life will never be the same. If you want to learn more about how to use it hands-on, just sign up for one of our workshops or send me an email. You've got my email address at the bottom of each page. You can run these numbers. You don't have to be a 12-year-old with a math degree, but if you have a 12-year-old with a math degree to help you, that is very, very helpful. You can also go to estateview.com and you can see videos on these different types of planning and calculators. For example, if you're interested in a qualified personal residence trust, you can go to estateview.com, go to our video library, click on qualified personal residence trust, and there's a video of it. We thank our Estate View creative engine with Jerry Hesh, John Blottmacher, Bob Keebler, Marty Shinkman, helping to keep us out of trouble. And here we go with estate tax basics. The first thing to know is what one of my favorite law professors told me in the first day of estate planning courses. He said, the estate tax is a voluntary tax. If you don't do any planning, you pay the tax. If you do some planning, you pay less tax. And if you do the right planning, you will pay no tax. That may include some charity, not necessarily, but what we see over and over again is that when someone dies, the family says, oh my gosh, we have to pay estate tax. Whereas if 20 years before they had said, oh my gosh, we need to plan for the estate tax, then there would be no estate tax whatsoever. If you have a 20 to 25 year runway, you could end up with somebody having a $20 million net worth based upon notes that vanish on death, and hundreds of millions of dollars of assets in irrevocable trust that person controlled, but would not be subject to federal estate tax on. So it's really important to keep your eye on the ball in this area. Nobody thinks that they're going to die anytime soon, but this is the one type of planning that you really can't procrastinate. In addition to federal estate tax, you have state estate tax. Pennsylvania, it starts on the first dollar. You could die with $1 and still pay a Pennsylvania inherent estate tax. In New York, it starts at about 7 million. And if you're $1 over, you're taxed on the whole 7. So New York can be perilous. Illinois, pretty big tax. Massachusetts, pretty big tax. So the strategies we're going to show you here will work both for state and federal estate tax. And then I have to say, don't try this at home alone. Anyone who even does their own legal work has a fool for a client, as F. Lee Bailey said. Get some help. And I'm really proud of the subscribers at Estate View. We're putting up a map on our website so you can find an Estate View subscriber. Estate View is not so easy to use. Click here, click there, and get the perfect estate plan. It just helps start a great estate plan, but it gives a qualified advisor a lot of tools that, quite frankly, we didn't have before. So the federal estate tax is imposed on citizens and residents of the United States. If you are a non-resident alien and you have property here, there can be an estate tax, and it starts at a very low number, like $160,000. But if you're a U.S. citizen or a resident of the United States, meaning you have your green card, then you enjoy a $13,990,000 estate tax exemption. So I could die tomorrow if I haven't made any large gifts and my estate is $14 million, then the estate tax will be 40% of $10,000. That's $4,000. This exemption goes to $15 million January 1st, 2026. I imagine in the last week of January, there will be people in intensive care, and the doctor will say, do you want to pull the plug on grandpa? Well, let me think. It will save me $400,000, actually $404,000 to get grandpa through to January 1st. So among the wealthy, we're going to have low death rates in the last week of December and high death rates in the first week of January. I once wrote an article called When to Unplug Great Grandpa. Estate Planning Magazine actually published it and didn't change the name, which puzzled me a little bit. Now, the next part about the estate tax is the annual gift exclusion, or the annual gift exemption. So I can gift up to $19,000 a year to a person, no matter how small they are, and that is not counted against my $15 million 2026 exemption. So if I have 10 children and grandchildren, 10 times 19,000 is 190,000. I give them all $19,000. Now that brings my estate from 14 million to less than 13,990,000, and there's no estate tax. Now, the 19,000 is based upon a $10,000 amount that goes up with inflation every year. So next year, I am thinking that it will probably be $20,000. Haven't run the numbers, but that's probably where it's going to be. And that's good because it's easier to round the numbers. While we're talking about the gifting, I want to make sure I mention that what I spend on direct payments of tuition and direct medical payments, including beautification plastic surgery, or medical payments to a psychiatrist to try to straighten out my family after how I raised them, those also don't count. So you could have someone with a $20 million net worth, but they spend a lot of money on tuition, they spend a lot of money on medical expenses for their family, they spend a lot of money enjoying their lives. That can reduce the estate tax exemption. So that's page 9. And I think the puppet, I got it. He's sleeping. He's sleeping. He has sleep apnea. So, all right. Now, there's a lot of techniques that we use to reduce the federal estate tax. And some of them are listed here on pages 10 and 11. And I have found a very effective way among many clients is to spend money or invest it poorly. So if you're wealthy and you've hit home runs and you've done very well, or you got it the old-fashioned way by inheriting it, please know that lots of people lose it in bad investments. They get bad advice. They size things up not quite right. So please be careful there. Number two, that annual gifting. And we're going to talk about how to do annual discounted gifting. Number three, if you have life insurance or you want life insurance, then if you own it or control it or have what they call an incident of ownership, it's in your estate when you die. But if it's in an irrevocable life insurance trust, which buys it fresh or has it at least 3 years before you die, then it is not subject to estate tax. There are situations where you would buy life insurance to make sure that there would be plenty of liquidity to pay the estate tax on death, but that reduces other things that you can do. We'll talk about that a little bit more later. Number four, discount vehicles. Now, I'm not talking about the Kmart van when I talk about a discount or a dollar store van. What I'm talking about is, let's say I have a $20 million net worth. It's $1 million house and $19 million of investments. I put the $19 million of investments into a limited liability company, owned 1% by my daughter as voting member, and 99% by me as non-voting member. I've only made a 1% gift to my daughter. 1% of 19 million is what, 190,000. I file a gift tax return. My exemption is down from 13,990 to 13,700 maybe. Then I die. What is my 99% interest in an LLC that I can't vote in worth? We might be able to take a 35% discount. So 65% of $19,000 may be less than 15 million. So those are the discount vehicles that sometimes people use. And for those of you who are planners, there's a lot of experienced planners on this program today. Don't forget that, you know, you've had your clients sell a lot of assets for a big note. Well, do you want creditor protection for the note in case the client gets sued? How about putting it in an LLC partly owned by the client's daughter? And then when the client dies, maybe that note will be discounted in value. Number six, sometimes we sell assets to an irrevocable trust. I'm going to go more into depth on that, but the installment sale of assets to an irrevocable trust, also known as the installment sale to the grantor trust, or maybe I'll call it the Blockmacher sale, has probably saved more federal estate tax over the last 20 years than any other technique. And that's for a very good reason, because I'm going to be showing you the numbers on that. And then number seven, when someone has a short life expectancy, it is possible to sell assets for what's called a private annuity, or maybe for a self-canceling installment note. I'll show you that also. Don't try this at home. You need to have good advisors. And then before I go further, I want to just mention marital planning. Those of us who are married and hope to stay married must engage in marital planning, and that's beyond just counseling and making a lot of apologies. You should also be aware that if you are predeceased, meaning your spouse dies before you, if they don't use their entire $15 million exemption, then you can inherit that. And it's called the portability allowance. It has nothing to do with mushrooms. And so, for example, I die, I leave $12 million to my children, and the rest goes to my wife, Marcia. I've only used 12 million of my 15 million exemption. Marcia's exemption goes from 15 million to 18 million if the personal representative of my estate files an estate tax return and elects for that to happen. So on a lot of second, third, fourth, fifth, whatever you are on the marriage,
You have a written agreement which requires the first dying spouse's personal representative or executor to cooperate with portability. But before that spouse dies, if I make a $10 million gift to my children and Marcia signs a gift tax return agreeing that it is considered to come one half from her, then I only use 5 million of my exemption and I've got 10 million out of my estate, and I've used 5 million of Marcia's exemption. And if she doesn't have a lot of assets, that will not impact her children, and I can agree to pay for any expenses or loss that her children would have as a result of that. So you have to, when you're on a first marriage, second marriage, whichever marriage you're on, it's a little bit of hopscotch, but there are estate tax planning techniques that come into play with respect to that. Okay, enough of slide 10. There's also a slide 11. Not every technique works well for every person. The technique that worked for your neighbor may not work for you. So you really have to run the numbers. And the math is the reality. It's very easy to say, well, I think this would work. I think that would work. It seems like this would work. But until you run the numbers on the client's specific information, you're really not going to be able to get a good feel. But one thing I will say is when you sit with a client, when I sit with somebody and they have a $10 million net worth, I can safely say if they're properly investing and not spending too much, there's a great chance when we get together next year, in 10 years, you'll have a $20 million net worth. And then 10 years more after that, you'll have a $40 million net worth. So we should get started with the planning sooner than later. I also don't want to forget the federal estate tax charitable deduction. I'm sitting there with a client with a $20 million net worth, and I'm throwing out all these great ideas. And the client says, 5 million of my $20 million net worth is an IRA. And I understand that when I die, there's not only going to be a 40% estate tax on that IRA, but there's also going to be income tax when the IRA comes out. What if I just make that IRA payable to the family foundation? I say, what family foundation? You didn't tell me you had a family foundation. Well, you didn't ask if I had a family foundation. Okay, so you have a family foundation or a community foundation account or a child dedicated to charitable purposes. So the 5 million goes to the charitable trust or the charitable organization. The children control it. There's no estate tax, there's no income tax, and then the charitable organization could hire friends and family members to do legitimate white-collar charitable work and manage the foundation. So that's not at all uncommon, and you can even go further. If the client says, well, I like the idea of charity, but I like my kids more, is there any way to get 100% charitable deduction on that, on a $5 million disposition? And have something more for my children? And the answer is yes, with a charitable lead annuity trust. Now, if you have business interests, you don't have to pay the estate tax right away. If you have a business that's more than 35% of the adjusted gross estate, you can get a 14-year payment plan. Or if you have multiple businesses that, when put together, reach certain guidelines, you can get this payment plan. If your business is renting properties, and a lot of wealthy Americans have hundreds and if not millions and billions of dollars in properties that are rented. If it's an active rental situation, it can qualify as a business and get that 14-year payment plan. If it is not active, if it's all triple net leased or somewhat inactive, then you don't get the payment plan. So a lot of taxpayers out there, in order to get the Section 199A 20% deduction off of income, in order to get what we call a 6166 payment plan, should be making their lease arrangements active and not passive. Okay, going back to the $19,000 per year gift tax exclusion. You could give that $19,000 directly to that bratty grandchild who may spend it immediately at GameStop, or you put it in a trust and the trustee writes the grandchild a letter. And the letter says, "Dear grandchild," they deliver it to the grandchild at GameStop. "Dear grandchild, your grandfather just put $19,000 in a trust. You have 30 days to withdraw the $19,000. If you don't withdraw the $19,000, then it will be held in the trust for your future benefit at the discretion of the trustee. If you do withdraw the $19,000, you will be written out of your grandfather's will and your allowance will stop, and we want your car back also." So that qualifies for the annual exclusion. So that comes from a 1968 court case called Commission versus Crummy, which is why a lot of people have crummy trusts. And when you're forming an irrevocable trust, it may as well be a crummy trust. Maybe you'll get a discount because it's not so good, but that's what those withdrawal powers are for. And you could even give a withdrawal power to your spouse, but it should not be, generally, it should not be more than $5,000 or 5% of the value of the trust, or the $19,000, whichever is less. So if it's $1 million trust, you can go up to 50,000, so you're limited to 14,000. But if you have a $100,000 trust, 5% of 100,000 is 5,000, would be the most that of the withdrawal power and the most of the exclusion that could be used. So a lot of you out there have irrevocable life insurance trusts, and you make the annual premium. Maybe it's best to give that premium dollars to the trustee of the irrevocable life insurance trust. The trustee uses it to pay the life insurance premiums, and notice is given to your children, or you make sure your children know that they have had 30 days or whatever number of days is listed in the trust company, in the trust agreement, in order to withdraw what went to the life insurance company. You don't have to wait the 30 days. I've only once in my career seen anyone exercise a withdrawal power, and that was one upset grandfather, I will tell you, and that grandchild lived to regret it. Okay, so annual gifts and life insurance, we've talked about. If you're going to do a life insurance plan, make sure you run the numbers to make sure that it will be advantageous. If you transfer a life insurance policy that you own out of your estate, you could either sell it for fair market value, which could trigger income tax when you die, or you have to live 3 years after the transfer. So for a lot of clients, we'll set up the irrevocable life insurance trust, we'll fund it with cash or marketable securities, and then the life insurance trust will buy the life insurance policy, and we will make sure that the life insurance trust is considered to be the person for income tax purposes. We'll talk about that in a few minutes so that we don't trigger something called the transfer for value rules under Internal Revenue Code section 101. If you want to fall asleep tonight, just start reading section 101 of the Internal Revenue Code. So I'm going to show you some real numbers using Estate View in a few minutes, but you have them on these slides as well so that you can see how these things work. One thing I see on this slide that I didn't mention is the ability to fund what we call a bypass trust or a credit shelter trust or a B trust on death. So I die, and let's say my exemption remaining is 11 million. I don't want to leave that to Marcia because then it'll be subject to estate tax in her estate. So I leave it to a special trust. I like to call it a bypass trust or a credit shelter trust because it takes my credit shelter, and in this example, 7,665,000 on my death goes into a trust. Now, there's no portability allowance to Marcia of 7,665,000, but if the bypass trust grows at 4%, then after 20 years, it'll have 13 million in it that will be outside of my estate for federal estate tax purposes. The portability allowance doesn't go up with inflation. The credit shelter trust does. The credit shelter trust also, on the second death, can benefit our children without ever being subject to federal estate tax at their level. And that's another big thing that we address in estate tax planning. The portability allowance is not eligible to fund a trust that can benefit my descendants without being subject to estate tax at their level. And that's called the GST exempt rules. So again, in this example, on Bob's death, he could put $7.6 million into a bypass trust, and then on the second death, the bypass trust is never subject to estate tax. There can be a disadvantage to the bypass trust. The disadvantage is that when the surviving spouse dies, the assets of the bypass trust do not go up in value to fair market value for income tax purposes. So if I leave the $7.6 million to Marcia, and then when she dies, it's worth $13 million, the $13 million of investments will get a new income tax basis of $13 million, and our children can sell those assets and not pay income tax. So when I die, if I've planned properly, Marcia should have 9 months after my death to decide what portion of that $7.6 million allowance is going to go into the bypass trust and what portion is going to come to her or go to a protective trust for her in order to allow a portability allowance and a step up in income tax basis on the second death. So that's just something that we attend to. If it's over your head, you're a layman, listen to this again and then go explain it to your tax advisors. What we do in the document, in the trust document, is we provide that after the first death, the trustee or the surviving spouse can make what's called a Clayton Q-tip election. Now, that doesn't mean that her next husband is going to be named Clayton, but what it does mean is the Clayton case that allowed that to happen would apply. Now, whether Mr. Clayton knew Mr. Crummy, I don't think so. Clayton was later than Crummy and probably didn't want to hang out with crummy people. Advisors, if you have a life insurance policy, instead of funding the policy in a life insurance trust with annual premiums and crummy powers, consider split dollar advances. When the interest rates were low, you could be charging 1-2%, the long-term applicable federal rate on each advance. Now, the interest rates are at about 4.75% for most split dollar advances. But if the client is under age 70, you could do an economic benefit split dollar arrangement, which would be the equivalent of a very low interest loan. And that may allow the life insurance to work a lot better. And that's shown here on the slide on page 34. And then I want to talk about Section 529 planning. So I can put assets, and actually up to $529,000 in Nevada of assets, into a Section 529 college savings plan, which can grow income tax free as long as it is only spent on qualified items. Qualified items include up to $10,000 a year for kindergarten through high school tuition, plus tuition and reasonable room, board, and other expenses of a college student and a graduate student and a postgraduate student, plus vocational. So I'm going to show you how to guess how much should go into a 529 plan, but it's very income tax efficient. And then there's another nice thing about a 529 plan, and that is I can put $19,000 a year into a crummy trust for my granddaughter, or I could multiply that by 5 and put $95,000 into a 529 plan, and that will be considered to be a $19,000 gift this year and then the next 4 successive years. So that gets it out of the way. I've got the time value of money working for me, but I can't use discounts. So what a lot of clients do is when they have a trust that's already funded for their descendants, or they have a family LLC that's being pushed towards the descendants, like I'll show you, that could invest in the 529 plan merely for the income tax advantage. Now, I will say that I expect that when my granddaughter goes to college, and there's a lot in that 529 plan, I'll probably still pay her tuition because that will not be considered to be a gift by me. This assumes that she shows up at school. They don't kick her out. But if she doesn't use the 529 plan, I'm very confident that we can find other family members that can use that 529 plan. Because every year you can transfer a 529 plan in whole or in part to another person within the family, like to a sibling, and then one year could be from this to a sibling, the next year from that sibling to a child of the sibling, then the next year to a sibling of that sibling, so it can get moved around over the years. And then finally, or did I already say finally? Well, anyway, finally, there is the qualified personal residence trust. And with the qualified personal residence trust, I set up a trust which basically says, Alan, thank you for setting up this trust. You can live in this house for 10 years rent-free, no problem. At the end of the 10th year, the house is out of your estate, and the amount of gift tax exemption, estate and gift tax exemption that you use to get the house out of your estate is significantly discounted. So, for example, a house worth $2,140,000, if I want to give half of the house to a Cupert, I'm going to take a 15% discount. That makes it a $909,000 asset. But when I put it into the 10-year trust, it may only be worth a $500,000 gift because my children won't get anything if I die during the first 10 years. And the Internal Revenue Code allows us to use that as sort of an arbitrage. So I've only used $500,000 of my exemption. After 10 years, that property may be worth twice as much, and that's a lot out of my estate. And then even better than that, I can pay rent to the trust. That doesn't trigger any income tax. I can pay rent, and that reduces my estate even more. So now I'm going to give you a little breather, and I'm going to move over to Estate View software, which I started working on in 2012, and I keep telling Marcia I'm almost done. And I'm an established subscriber, so I click there, and up comes the calculators. So I'm going to go to Instant Plan. That's the easiest place to start. And I'm going to pick a client. Or I can add a new client, and I can put in the client's name, Alan Jones. Is the client married? Yes. Married to James Smith. And I'm going to just use my sample data instead of filling out the form. So I'm going to create this client, and there's Alan Jones, goes by Bobby. That's not quite accurate. We'll go by Al. And Alan is 60 years old. He's a youngster. He uses tobacco, so his life expectancy is 18 years. If he didn't use tobacco, it'd be 24 years. Is it worth 6 years? I don't think so. Let's go without tobacco. And he is a U.S. citizen, and he's used $250,000 of his estate tax exemption, and we'll go to the next page. I only have to fill out the yellow items to get my calculations done here. I can fill in other items and do other things, which I can show you. Now, Jane is 55. She is female. She has a 31-year life expectancy as a non-tobacco smoker, but she has either one of her or Alan will be living at the end of 35.8 years. There's a 50% chance of that. So you can't run these numbers based on the life expectancy of the youngest female spouse. You have to run them as joint. Now, if she's a smoker, it's only 25 years, and the joint life expectancy goes down to 30 years. But I'm going to say she's not a smoker. And she's used 500,000 of her exemption. So I go to the next item, and I see that they have 3 children and 1 grandchild. So that's 4 of them. And I will eliminate the rest of them. Wouldn't it be great if you could just eliminate that grandchild you don't like? Just like push a red button and then they're gone. So that's their children. And now I'm going to put in some key financial data. And this is very important. We need to know if they're saving or spending every year, because there's a huge difference in the numbers. If he's saving 400,000 a year until he's 70, and then he'll work less, he'll be saving 200,000 a year, and then let's say at 77, he'll start net spending 300,000 a year. We want to know that. And then after his death, if she'll be spending, say, 250 a year or 200 a year, then we want to know that also. And I find that most of my clients have 3 tranches. So we've got 3 tranches there. What am I saving or spending now? What will it be at a certain age? What will it be when I slow down at a later age? Okay, so then they have a house, and it's worth $2 million, growing at 4.25%. And that's their home. And then they've got a second home. Let me find their mortgages. Okay. Now, he's got an IRA worth $3.4 million. It's 60% stocks, 30% bonds. She's got an IRA, $3.5 million, 60% bonds, 30%. I'm sorry, we can make her 40% stocks, 60% bonds. And then outside of the IRA, they have various investments, and you can make this long or short, but they have various investments of 18,850,000, growing at a rate of 7%. So not all that aggressive, and their allocation is 60% stocks, 30% bonds. Now we go to charity. They would be interested in leaving assets to a charitable lead annuity trust if that's what it takes to avoid estate tax. And then on life insurance, we can say they've got some life insurance. Also, when you're here, if you want to know what life insurance would cost, so for for Alan, non-smoker, we go here, and if he wanted what's called a guaranteed universal life policy that would have almost no cash value, but a guaranteed death benefit on death, I can click on add policy, and per million, that's going to cost about $9,000 a year per million, and I can just click up to 2 million, and he would want that in a life insurance trust. And so that's their information. I can click on review summary to see if I want to change anything, and I can also click on assumptions to see if I want to change anything. And some of the assumptions are that he's going to retire at age 70. The estate tax is 40%. If there was also a state estate tax, I could move that up to have a combined rate. Gift tax rate is 40%. Inflation et cetera, et cetera. Capital gains rate, 23.8% when you include the Medicare tax. If they're in California, I would move that up, or I would move them out, one or the other. And then there's all kinds of techniques we can use for them. So I click on results, and it just ran 50,000 calculations, which included Monte Carlo calculations. And now I'll click on Married Comprehensive. So here's where they are, and I'll expand this just a little bit. So here's where they are today. They have 2.8 million in houses and 30 million of investments, 600,000 of life insurance before we make the change. And if they die this year, they've got a $2 million estate tax. And they're going on vacation. And maybe we'll move their investments into an LLC to get a discount, and they won't have an estate tax. If they die in 1 year with a $15 million exemption, then 2,152,000 would need to go into that charitable trust, which would basically break down to having half or 2/3 of it go to charity, half or 2/3 of it going to the children, depending on economic performance. But, that's not a problem, so they don't really need planning, right? Wrong. You knew the answer to that. Let's say they do no planning, and we go to life expectancy. So in 24 years, that house is going to be worth 7.6 million, investments 100 million, and the estate tax will be 46 million. That exemption will go from 15 million to 7 million, but still there's a heck of a lot of estate tax there. Now, if we fund a bypass trust on the first death, then we'll have 16 million set aside on the first death, which will grow to 34 million by the second death, and we will not have the estate tax situation as bad. The estate tax will go down from 46 million to 39 million. So it's a good thing you've got the ability to use that bypass trust. But the next thing we can talk about is, should they consider using a qualified personal residence trust, or two of them? So what I've had them do is put their their homes into qualified personal residence trusts. Estate View is assuming that the term of the trust will be 80% of their life expectancy. So the Cuperts allowed them free use until about year 17. And then they started paying rent to be able to use the first Cuperts. The husband here has a shorter life expectancy, so his Cupert term ended earlier, and he had to start paying rent to use the house. So after 24 years, his half of the house is worth 3.8 million that's out of his estate, and the cash from the rent is 2.2 million when the rent was reinvested at 7%. And in year 36, you've got $12 million worth of house and $8 million of reinvestment from rent. So you have $20 million in the Cupert. And the value of that gift probably only used about 1.6 million of their exemption. So anyone who tells you that Cuperts aren't worth doing should really run the numbers. And if we have time, maybe next week, I can show you the Cupert calculator. Or if you want to know more about any of these techniques, go to estateview.com, go to the library, and then click on the technique, QPRT, and you'll see a video on how to use it, and you can use it yourself. But that gets the estate tax down from 39 million to 31 million. And then you say, what is the maintenance on the Cupert? Is there a tax return? No. Is there an account it has to hold? No. Does it need a financial statement? No. Does it impact my insurances? Maybe. Check with your agent. We've never had a problem. Could it cause loss of the $500,000 exemption on sale for income tax purposes? Not if you sell it while you're still alive. If you sell it after you die, you may or probably lose the income tax advantage. So be aware of that. Could it impact my property taxes? In Florida, it won't if you do it right. In California, it may. So it is somewhat state specific, or in California, you could say state Pacific, couldn't you? All right, well, do I need more estate tax planning? I think so. I'm not done billing you. So how about annual gifting? Well, it's only for donees. It's only 20,000 each a year times 4, 80,000 a year. What's that going to do? Well, in 24 years, growing at about 6%, that trust is going to have $10 million in it that passes estate tax free, reducing the estate tax from 31 million to 22 million. And what if you transfer discounted LLC interests and take a 30% discount? Then that gift trust, instead of giving cash, you're giving LLC ownership interests. That gift trust, instead of being worth 22 million, with an estate tax of 22 million, you see how those numbers are really close to each other. 22 million, 22 million. I'm a psychic. But now, with discounted gifting, the estate tax is down to 18 million, and the gift trust is up to 32 million. So is it worthwhile for your advisor to call you every other year and say, hey, you need to do your December 31st / January 1st transfers of those LLC interests to the trust for your children? And you go, what? Yeah, you do it every other year. We've sent you 96 emails, but you're saving $4 million. Just pay us a percentage of the savings if you don't want to pay us for the 96 emails. So that discount annual gifting, good stuff. Life insurance may help, may not help, depending upon whether you die before or after your life expectancy. And then how about a large gift? And this wipes out the estate tax. So what are they going to do? They put 33% of their investments. So their investments are 30 million. They put 10 million into an LLC. The 10 million that goes into the LLC, well, actually, it's only 7 million. So they put 6.5 million into an LLC. That reduces their investments to 23 million. Then they gift 99% of that LLC. They call it a $4 million gift for use of their exemption. By the time of the death of the survivor of them, that trust is 85 million. There's no estate tax. So a large gift this year may be the best result, but not everybody wants to make such a large gift. By the way, that gift could be to a trust for the spouse. The first spouse makes a transfer of his ownership interest in that LLC to a trust for the lifetime benefit of the other spouse. So the other spouse can use the assets if needed for health, education, maintenance, or divorce. All right. So let me go back to assumptions now. And I will say they don't want to do the Cupert. They live in California and they were advised not to do the Cupert. And they're not going to do the life insurance, and they're not going to do the large gift. So I click back to results, click back to Married Comprehensive, and where am I after discounted annual gifting? Now I'm at a $26 million estate tax after discounted annual gifting. Now, I'll skip rolling grats. I can do rolling grats. That'll save a little bit. I'm still at a $25 million estate tax. So what do I do now? Now I take 33% of the investments, which is 7 million, and I put it in an LLC. I value the 99% ownership interest of the LLC at 4,000,009. So, or 4,000,005. So instead of 7 million of investments growing at say 7% a year, I now have a promissory note of 4,000,005 bearing interest at 4.75%, which is this month's applicable federal rate. So this trust is going to grow, and the way we design the trust, it is never subject to income tax. All the income taxes are paid by Alan and Jane. So this trust in year 24 is worth 15 million, and the note gets repaid to them. Their investments are 49 million. By year 36, the trust is worth 26 million. So the estate tax savings are $10 million just from making a sale of $7 million worth of assets. And this may be enough for them if they want to leave to charity, or I can simply go back to the assumptions where I was doing a 33% installment sale, and I could move this to a 58% installment sale. Click on results again, click on married comprehensive, go to my installment sale, and now my installment sale gets the estate tax down to 7 million. I put 12,000,005 into an installment sale LLC, sold it to the trust in exchange for an $8 million note. There was also a seed capital gift, by the way. They receive $379,000 a year on the note each year. They have plenty of cash flow, and that reduces the estate tax by significant amount, right? From 25 million to 17 million to 7 million. That's an $18 million reduction in estate tax. But what about the charity? So instead of 7 million of estate tax and the descendants receiving 180 million, voluntary tax here, isn't it? 7 million of estate tax, beneficiaries get 180 million. Instead, charity gets 18 million and the descendants get 169 million. Over 20 years, the family foundation gets 11 million, and then the kids get an extra 7 million too after 20 years. And at this point, the client may say enough of the techniques, or the client may say, show me that Cupid again, or let's make a 10% gift. So I can go back to assumptions, and I can say, let's make a large gift. Yes. But let's just make it a 10% gift. Or how about a 20% gift? Click on results again. Click on married comprehensive. Take it down there. And there you see that the large gift brings the trust to 66 million, the estate tax to 14 million, and then the installment sale brings it home. No need for charity. So these are people who started early. Now, something else I can do, and I had planned to show you a lot of other calculators, but I'll just stay with Instant Plan. Now I'm going to go to something, though, called Monte Carlo results. So I'm going to click on Monte Carlo results. And what this is showing me is that based upon the history of the S&P 500 and bond markets since 1936, based upon 66% stock, 33% bonds, and a 31-year expectancy, there's a 9% rate of return before expenses. And there's a 25% chance that there'll be a 10% rate of return. So I really maybe need to run my numbers again. What if this was a 10% rate of return? So that's worth looking at. By the way, if you go ahead and put your data or your client's data into Instant Plan, you can also have a nice family tree, which I like to have for meetings or calls, so I remember everybody's nickname and when their when they're born and all. You've got a calendar of birthdays and anniversaries. You've got all their contacts. You can show them their required minimum distributions and the impact of charitable distributions from their IRAs. This is all immediately printed out for you. You can show them based upon their rate of spending and savings and contemplated growth of assets, when they'll start running out of assets and whether they can safely retire based upon a certain amount. There's all kinds of neat things here that you can do. Let me mention some alternatives that this couple has. They could sell assets for a note or loan assets to a family member. 3-year note, 3.96%. 9-year note, 4%. Over 9-year note, 4.76%. If he sells assets for a self-canceling installment note with a 22-year balloon, it would pay him 6.8% interest, and if he dies during the 24 years, the note vanishes. The IRS says he should be in reasonable health to do that. If he's not in great health, he could use a private annuity and put $1 million into the trust in exchange for receiving $54,000 a year. And when he dies, nothing's in his estate. So there's even more effective uses of private annuities, but for clients with short life expectancies, if you want to zero out estate tax, the private annuity is a great opportunity. And then we did not get into the grantor retained annuity trusts. Most clients are not going to use a grantor retained annuity trust when they can use an installment sale, but we do have a rolling GRAT calculator. If you have a large portfolio and you really don't want to do any of this stuff, and you want to do something that's very low cost, fairly simple, and simply allows the growth over a reasonable rate of return to pour into estate tax-free trust for your spouse and children, then you may consider the rolling GRAT. The last thing I'll show you, just for you experienced planners, is once I've got this client set up here, I can also generate a planning chart. So now their information, their intake information, is all in an Excel spreadsheet. The Excel spreadsheet shows me their RMD expectations for his IRA, shows me a summary of their assets and net worth, shows me the assets that they didn't give me values on or that need more information, shows me their entities, shows me the values of their entities, shows me what they own jointly, and shows me also all their contact information, who they're appointing to be their personal representative, and things like that. And also gives me a red flag report on things to make sure I discuss with them concerning their planning. So that's the spreadsheet that comes out. And then I just accidentally shut down Estate View, and I wanted to show one more thing as I go over my time, and that is once I have my results, I can save my results to my calculators, click on Save. Now I can go to all these calculators, and the one you're going to most likely go to is going to be single client or married. And then all that data that we were just working with is all here with all the decisions. And now on the left-hand side, you can go into a lot more detail. You can put a lot more detail in there to custom design it. And when you change something on the left, you instantly see the result on the right. So if I want to know whether to installment sale more or less, then when I click on the left, the data is changing in the middle. And then there's also a timeline which shows me what the estate tax will be in each year, depending on what year they die. And then I can move them, depending on whether I like the first spouse or not, I can have them die sooner or later. Most clients don't realize that we have that power, but we actually do. So let me go and see now if there are any questions. Okay, Thank you. I appreciate that. Great looking materials. Can you provide recommendations for using these in our work and how they integrate with the software? Well, the materials don't really integrate with the software, but you can use the software to generate PowerPoints. A lot of the illustrations you see here were made with the software. Okay, Alan, what contact info should I use to update the status of my subscription? Can't seem to access the program, but it's been a while. Okay, well, Gary, if you want to just send me an email, I'll be glad to set up a time. Send me an email with any day and time, and so one of our Estate View people will be glad to get with you to help onboard you. All right, so that's that question. And then, many thanks to Mr. Puppet for doing this presentation. Okay, well, what about me? Hey, I like me better. Okay, I do too. All right, will we be receiving a recording of this program? Yes, whether you want it or not, you will be receiving a copy of the program. Are the slides available for download? They should be on here. If you did not receive the slides, let me know, and I will send them to you. Let's see if there's any other questions. Nope, that's it. Well, I want to thank all of you for attending this program, especially Estate View subscribers. I really appreciate all the support, all the ideas, all the constructive criticisms that you've given us. And for those of you who have your own estate to plan, or the estate of a loved one to plan, don't forget that you don't want to inherit more if you already have enough. They can go in trusts that can benefit you for your lifetime and never be subject to estate tax on your death. And don't forget to run the numbers. Even if it's on a spreadsheet, rudimentary, whether it's on Estate View or somewhere else, you've got to run the numbers to understand what the results are going to be. Thank you. I hope that this helps you help others and that you have a heck of a good rest of your weekend. Okay, Puppet. This concludes a terrible program. It was just awful. I hated it. And thank you very much for supporting this dummy. Yeah, thank you. I appreciate that. You should. Bye.